Hello, my name is Richard Griffiths and I'm the owner and principal analyst at Investment Strategy Wire. Investment Strategy Wire is a macroeconomic research house, and these introductory videos explain our approach to investment analysis and the rationale that lies behind this. The first video introduces Investment Strategy Wire and discusses the possibility of how an increase in macroeconomic structural uncertainty may be the key factor underlying the dynamics of financial markets today. We call this the new abnormal. The second discusses the strategic implications of the new abnormal idea and how investors may profit from this. The third looks at a mapping tool that helps capture the key dynamics of financial markets, thereby assisting macro scenario development. The rest of this video further introduces Investment Strategy Wire before discussing the new abnormal idea. Investment Strategy Wire is a macroeconomic research house providing financial advice and services for investor clients. Investment Strategy Wire is top-down, global and cross-asset class in scope. Our principal idea is to make uncertainty and risk considerations explicit, and by understanding them better, to enhance investor returns. Our primary goal is to capture the reality of the global investment landscape using the following investment principles to shape our approach. Realistic, flexible, innovative. This, the first of our introductory videos, explains the reason behind Investment Strategy Wire's focus on uncertainty, as well as the reason behind the choice of our investment principles. Our main hypothesis, and the reason the site is shaped the way it is that there has been a change in financial asset pricing, with an associated change in financial asset return behavior due to increased structural uncertainty because of changes to the world's macroeconomic structures. We call the changes caused by increased structural uncertainty the new abnormal. Our point is that changes to pricing and return are not simply linked to changes in macro structures, but to the level of uncertainty that these structures generate. Our principal hypothesis, therefore, is that there has been an increase in the structural uncertainty of the macro factors driving financial markets. Moreover, this may be insufficiently recognized as a fundamental factor driving financial asset prices and returns. In other words, changes in financial asset pricing may not be just linked to the collapse of the US super bubble in 2007-08 and the rolling crisis that has followed, but also to deeper factors. If we are correct, getting to grips with the factors driving structural uncertainty should lead to an enhanced market understanding, and from this, superior investment insight and investment advantage. Much of the performance of asset classes since 2007 can be explained by the new normal concept, which defines a balance sheet constrained economic world with low growth and deleveraging as economies adjust to the aftermath of the US asset bubble collapse. This new normal world is a world of demand maintenance through maximal fiscal and monetary policy, combined with extraordinary monetary policy, i.e. QE, plus ad hoc bailouts of systemically important institutions and insolvent advanced nations. This contrasts to the economics of the old normal, which was a form of policy-managed growth with low inflation, with this economic performance associated with moderate policy settings. The new abnormal idea adds a further dimension to the old normal versus new normal distinction by introducing the possibility of a secular increase in structural uncertainty as a, or at times the, primary issue underlying the dynamics of financial markets. What is the importance of this? Elevated uncertainty is important because if we are correct, we can expect new patterns of risk, and from this more fluid market structures, leading to new financial asset pricing patterns, and from this new financial asset return patterns.
If correct, this has crucial implications for investment strategy, particularly for investors with active mandates. What are the specific factors that might lead to such an increase in structural uncertainty? First, in today's world, there are now three major economic regions: the US, China, and the Eurozone, with each having the capacity to shock and then drive or dominate global financial asset pricing. The continual interplay of economic shocks from the three regions, as well as perceptions of possible shocks, is now perhaps the primary characteristic that drives global financial markets. Second, sustained surpluses and/or sustained excess domestic savings in certain countries means that there is a persistent danger of bubbles in systemically important assets as surpluses are recycled. Third, the level of competition from surplus nations means that nations unable or unwilling to adapt economically will at some point in the future, often when global growth stalls, face insolvency risks. Fourth, in a two-speed world economy, there is a continual risk that the stronger emerging markets have a tendency to overheat and form asset bubbles because of excess international liquidity or excess domestic credit, with the possibility of contagion elsewhere. Fifth, it is clear that financial markets normally discount economic anomalies rapidly and often overshoot in doing so. This makes financial markets pro-cyclical relative to the real economy, as the overshoot has a direct feedback to the real economy, exaggerating the main economic trends. Sixth, by observation, it is clear that the global cycle is now much shorter, as with G2 synchronous growth, assuming no offsetting recession elsewhere, commodity prices spike and the global economy starts to overheat almost as soon as it gets going. Seventh, the factor of accelerating social and political change. This can often have an important geopolitical dimension which has the potential to drive global markets due to supply disruption risks when it occurs in nations producing systemically important commodities, i.e. oil. To what extent has policy the capacity to neutralize or control these factors? First, coordinated policy and reform, whether via the G2, G20 or G7, is normally insufficiently wide-reaching to deal effectively with such issues. Instead, it invariably occurs only in extremis, behind the curve, and is usually frustrated on the most important issues by divergent national interests. Second, the response to Lehman Brothers and the Eurozone debt crisis shows that many last resort mechanisms are outmoded, being either too ideologically or fiscally insufficient to deal with advanced economy, systemically important institution insolvency issues and advanced economy government insolvency issues. Once again, reform is needed, but this looks unlikely given the scale of such a project. Third, sovereign wealth funds have been added to the IMF and other official entities as sources of bailout funds. This complicates the outlook for recovery risks, as the standard recovery rulebook will not necessarily be used. Fourth, QE has now become the norm in many advanced nations. Again, this may reduce uncertainty in the short term, but may increase uncertainty in the longer term due to government bond bubble puncture risks on policy exit. What are the impacts of these economic changes on financial asset pricing? First, multiple macro themes are likely to increase the frequency of minor and major shocks. If this is the case, we might expect a wider spread in expected returns, i.e. less kurtosis. Also, return distributions may become less continuous and more discrete or multimodal as the different themes batter against each other. Overall, prices are likely to witness multiple reversals between major turning points. Second, persistent surpluses and/or excess savings. Risk asset overpricing, i.e. bubbles, and with this, high tail risk and skew. In the bubble aftermath, risk profiles are likely to become more discrete, with policy events driving both risk and prices. Regarding timing, bubble puncture is usually difficult to predict, even when it is clear that there is a significant mispricing. Prices can be expected to follow a steady ascent followed by a sudden collapse with a choppy aftermath. Third, as national insolvency is often via a domestic banking or currency crisis, again we can expect high tail risk skew and more discrete risk profiles due to runs on currencies and domestic assets. Fourth, emerging market overheating again risks bubbles, therefore higher tail risk skew and the other main bubble characteristics. Fifth, financial market anomaly discounting is also likely to increase tail risk and skew, and with more discrete risk profiles, as serial policy steps address the underlying economic anomaly. Sixth, increased inelasticity for certain commodities produces inflation risk. This may introduce asymmetry into risk profiles due to the potential for policy tightening and sudden price reversals. Since 2000, markets appear to have become increasingly sensitive to discounting G2 synchronous growth, with the potential for an increase in risk premia for all risk assets at this part of the cycle. Finally, accelerating social and political changes may well increase geopolitical and supply disruption risks, once again increasing tail risk and skew and making distributions more discrete in nature. Importantly, the frequency of shock can be expected to increase as secular trends are driving many of these risks. Risk premia of relevant commodities, particularly crude oil, can be expected to increase. Putting this all together, we have a hypothesized world of more macro themes and therefore more market noise. We call this extreme immediate term reversals, or EITRs, with EITRs occurring on both actual or perceived risk changes, more turning points and shocks, and multiple equilibria. In other words, future economic and also non-economic events can put the global economy on different evolution paths, and as such we have a world where there is more than one possible set of future fair values or future equilibria for asset prices. Potentially more bubbles, therefore potentially more systemic risk, potentially more emerging market overheating, therefore potentially more systemic risk, potentially more national insolvency, therefore potentially more systemic risk, and lower supply elasticity in certain commodities, therefore more inflation shocks and policy reversals. And in relationship to policy, a policy response that is generally both lagging and insufficient, and with policy change slower than structural changes. Regarding risk, there are good reasons to believe that risk profiles are likely to be less peaked, i.e. less kurtosis, with greater tail risk and skew, and with less continuous and more discrete or multimodal risk profiles. Overall, this looks like a world of multiple price drivers producing a steady but discontinuous stream of shocks, both large and small, and with a range of significant background shock factors, many with high tail risk, occurring either at random or semi-predictable moments in time. Clearly, this is a world that is a long way away from the risk and pricing norms of standard financial theory. The key question for investors is how they should respond to such circumstances. This is the subject of our second video entitled The Strategic Response to the New Abnormal.